Welcome to the AgriAsia Commodities Podcast. I'm Dixon Poh, Vice President of the Soft and Agricultural Commodities Asia here at StoneX. This is your Sugar Weekly Update, where we take a closer look at the latest developments shaping global and regional sugar markets, from Brazil's accelerating production to policy changes across Asia and the broader macro currents influencing trade and investment flows in the months ahead. Let's get into it. It's been a difficult week for the sugar complex. Prices continue to fall, touching their lowest levels in more than 3 years as traders digested mounting evidence of a global surplus and steady production growth out of Brazil. The bearish tone was reinforced by a wave of speculative long liquidation as funds moved to unwind positions, reflecting a clear shift in sentiment from supply tightness earlier in the year toward a structurally oversupplied global market heading into 2026. On Friday, we saw New York raw sugar futures fall around 2% to 14.97 cents per pound, briefly touching a 4-month low. Meanwhile, London white sugar declined about 1.5% to $431 per tonne. That's the weakest level we have seen since July 2021. For the week, both contracts lost more than 3%, with the brief midweek bounce on higher oil prices quickly being erased. Overall, sugar has now surrendered nearly all of its 2025 gains, highlighting how swiftly the market's narrative has pivoted toward abundance. The decisive turning point came from Datagro's global balance forecast, which flipped the 2025-26 sugar outlook from a 5 million tonne deficit to around a 2 million tonne surplus. The consultancy cited stronger than expected recoveries in Brazil and India, along robust export flows from Thailand, whose refining margins have improved as the Thai baht weakened and logistics normalized. For Asian refiners, this shift implies increased availability of raw sugar imports at lower prices, easing input cost pressures for key buyers in Indonesia, Malaysia, and China, all of whom are entering peak refining demand season through early Q1. However, Brazil remains the anchor of the supply story. Latest data from Unica showed cumulative production through October 1st was up nearly 1% year-on-year, reversing the 12% deficit seen in early August. Cane crushing reached about 41 million tonnes in the second half of September, with sugar output up about 11% to 3.14 million tonnes, while ethanol production fell as mills continued to favour sugar due to stronger relative returns. Improved weather and operational efficiency have restored confidence that Brazil could deliver yet another record campaign, especially with Raizen reporting a 30% jump year-on-year in sugar equivalent output during the second quarter. Now, from an Asian lens, policy signals are increasingly active. China's sugar imports surged about 36% in September to 550,000 tonnes, reflecting opportunistic restocking at lower global prices as refiners take advantage of the softening market. Meanwhile, Indonesia has announced plans to introduce a 10% ethanol blending mandate by 2027. A move aimed at reducing fuel import dependency through greater use of sugarcane and palm-based biofuels. While that's a medium-term story, it highlights the region's gradual shift towards renewable energy integration, a trend that could modestly rebalance sugar demand over time. Elsewhere in South and Southeast Asia, India's ethanol strategy remains in focus. The industry continues to push the government to raise its blending target from E20 to E27 to absorb excess capacity. However, with production already ample and domestic consumption stable, the policy has yet to translate into meaningful market tightening. For now at least, India remains a contributor to the global surplus rather than a counterweight to it. Now, taking a look at things on the macro front, general sentiment across commodities have weakened. The US dollar's continued strength and tighter global liquidity have pressured fund inflows into softs, while falling energy prices have also eroded sugar's traditional correlation to ethanol. For Asia's import-dependent economies, however, the stronger dollar has had a dual effect, dampening speculative interest but also reducing landed costs as sugar prices fall faster than currency depreciation, improving refining margins for regional players. To sum it up, sugar's October breakdown signals a profound realignment in market fundamentals. The combination of Datagro's surplus forecast, Brazil's record production, and subdued demand signals has turned sentiment decisively lower. Yet, for Asia, the downturn also presents strategic opportunities. From cheaper import costs and margin recovery for refiners to longer-term policy openings in ethanol and energy diversification. Heading into November, traders will watch whether Brazil's weather and global energy markets can provide any relief, or if sugar remains anchored near multi-year lows through the year end. Well, that's all for this week's episode of the AgriAsia Commodities Podcast. I'm Dixon Poh, Vice President of the Soft and Agricultural Commodities Asia team at StoneX. Thank you for tuning in, and we'll be back next week with more insights into the global softs market and Asia's growing role in shaping them. Until then, trade safe and stay informed.
This podcast is for informational purposes only and is not a recommendation to trade, an investment research, or an offer to buy or sell any financial product. It does not take into account your particular investment objectives, financial situation, or needs. The trading of financial products such as futures, options, or swaps involves a substantial amount of risk and may not be suitable for everyone. Past results are not indicative of future performance. You are advised to perform an independent investigation of any transaction to determine whether any transaction is suitable for you.